Hello everyone, this is Gracie here. In this video, we will be discussing cost volume profit analysis problems illustration 10. So from the following particulars, calculate break-even point in terms of sales value and in units. And the second term is no number of units that must be sold to earn profit of rupees 90,000. So we are supposed to calculate the break-even point in terms of sales value and in units. Then the second question is number of units that must be sold to earn profit of rupees 90,000. So how much units are to be sold to earn a profit of rupees 90,000? Under that, fixed factory overheads is rupees 60,000, fixed selling overheads is rupees 12,000, variable manufacturing cost per unit is rupees 12, variable selling cost per unit is rupees 3, selling price per unit is rupees 24. So variable cost per unit, we will be calculating it. So variable cost per unit, they have given us variable manufacturing cost per unit is 12 and variable selling cost per unit is 3. So there are two variable costs. So we will add up 12 plus 3, which will give us 15. Then we will be calculating the total fixed cost. So here in this question, they have given us two fixed costs, which is factory overheads and selling overheads. So factory overheads is 60,000 plus selling overheads fixed cost is 12,000. So the total will be 72,000. So now they have asked us to calculate break-even point. So when we calculate break-even point, in break-even point formula, we require PV ratio. So first we need to calculate the PV ratio. So this is the break-even point formula. So we require PV ratio. In this question, they have asked us to calculate the break-even point sales value and in units. So I have already discussed in my previous video. Break-even point has two formulas. For value, there is break-even formula, break-even point formula, and for units, there is break-even point formula. So this slide will show you break-even point units. So calculating break-even point in units, fixed cost divided by contribution per unit, break-even point in terms of value, fixed cost divided by PV ratio. So if PV ratio is not given, then fixed cost, break-even point in value, fixed cost divided by contribution into sales. So any of these formulas can be used. So in this question, they have asked to calculate break-even point of units and break-even point of value. So let us use these formulas to calculate the answers for that particular questions. So to find out the break-even point, we need to have our PV ratio. So we know the fixed cost and variable cost, the total we have calculated. Now PV ratio formula is selling price minus variable cost per unit divided by selling price per unit into 100. So what is the selling price per unit in the question is selling price per unit is 24 minus variable cost per unit is 15, which we have totaled here, divided by selling price per unit, which is again 24, into 100 will give you the PV ratio, which is 37.5%. So next, using this PV ratio, we can calculate the break-even point value. So break-even point value is fixed cost we have in the problem, and we have found out the PV ratio. So fixed cost divided by PV ratio. So if you are taking percentage, no need to multiply by 100 because the formula is only fixed cost divided by PV ratio. So now fixed cost is 72,000. So how did we get 72,000? The total 60,000 plus 12,000 of fixed factory overheads and fixed selling overheads. So now the fixed cost is 72,000 divided by PV ratio is 37.5%, which is 37.5 into 100, which will give us rupees 1,92,000. Then they have asked us to calculate break-even point units. So the formula is fixed cost divided by selling price per unit minus variable cost per unit. So fixed cost is 72,000, selling price per unit in the question is 24, and the variable cost is 15 as per the calculation. So we will take that into consideration and find out 72,000 divided by 24 minus 15, which will give us 8,000 units. So we have found out the first question. So the next question what they have asked is sales units to earn a profit of rupees 90,000. So what will be the number of sales units which is supposed to be made to earn a profit of 90,000 will be found out. So sales formula is fixed cost plus profit divided by selling price per unit minus variable cost per unit. In order to solve all these problems, you need to learn by heart the formulas which was explained in the previous video. Make sure that you listen to that video properly and then solve these problems, which will be simple for you all to understand. So please make sure these formulas are by hearted. So fixed cost plus profit divided by selling price per unit minus variable cost per unit. So your fixed cost is 72,000 plus profit, which is 90,000. Where did you get 90,000? As we have told in the question, to earn profit of 90,000, what is the sales unit? So profit 90,000 divided by selling price per unit, which is 24, minus variable cost per unit, which is 15. So you will be getting 18,000 units. So to earn 90,000 profit, your sales unit should be 18,000 units. Only when you sell 18,000 units, you will earn profit of 90,000. So the next problem is illustration 16. So new shoe shine company sells 5 different styles of ladies chappals with identical purchase cost and selling prices. The company is trying to determine the desirability of opening another store which would have the following expenses and revenue relationships. So your new shoe shine company is sells 5 different styles of ladies chappal. So they are with an idea to open another store. To open the another store, these are the following expenses and revenue relationships. So selling price is rupees 30 per pair, variable cost is rupees 19.50 per pair, salesman's commission which is variable, which is rupees 1.50 per pair, and annual fixed expenses, rent, salaries, advertising, sundry expenses, which is rent is 60,000, salaries is 2 lakh, advertising is 80,000, sundry expenses 20,000. Then the other expenses here are, you are required to calculate the annual break-even point in sales units and sales volume. So both units as well as sales volume are supposed to be calculated. Profit or loss of the stores if 35,000 pairs were sold. The annual break-even point in units and sales volume if the sales commission were discounted in favor of rupees 81,000 increase in fixed salaries. The annual break-even point in units and sales volume if the stores manager were paid 30 paise per pair as commission. Refer to the original data if the store's manager were paid 30 paise per pair as a commission on each pair sold in excess of the break-even point. What would be the store's profit if 50,000 pairs were sold? Consider each question independently. So here they have given us 5 questions. Each question will be solved immediately. So let us get into the solution. So I'm sorry, each question will be solved independently. So let us get into the first question where they have asked us to calculate the annual break-even point in sales units and sales volume. So as we have solved in a previous problem, the same step will be used here. So first we will calculate the fixed cost. So what is the fixed cost given? The total fixed cost is 60,000 plus 2 lakh plus 80,000 plus 20,000, which will give us 3,60,000. Then we will look into our variable cost. So variable expenses are, there are 2 variable expenses where variable is 19.50 per pair and rupees 1.50 per pair. So which will give us rupees 21. So now let us calculate our break-even point in units. So the formula is fixed cost divided by selling price per unit minus variable cost. So as we have fixed cost, we have selling price per unit and variable cost. We will take this formula directly. The other formula is fixed cost divided by PV ratio. So any of that formulas can be used. So your fixed cost is 3,60,000 and selling price per unit as per the question is, which is 30 rupees 30 per pair. So 30 minus variable cost, which is 21, which will give you 40,000 pair. So now we will calculate the break-even point in value. So break-even point value, the formula is, so there are 2 formulas for calculating break-even point by value and break-even point by value. That first formula is fixed cost divided by PV ratio. The second formula is fixed cost divided by contribution into sales. So any of this formula can be used. But in this calculation, what they have done is, as we know the number of units of break-even point, they have multiplied the selling price directly. So you can do this, units into the selling price per unit will give you the total break-even point in value. You can do this or you can follow the formula fixed cost divided by PV ratio, or the other formula fixed cost divided by contribution into sales, any of the formulas. So if you find the units, you can multiply, if the selling price per unit is given, you can multiply the units into selling price per unit, you will get your break-even point value. So the break-even point units what you have got is 40,000 pairs. So into selling price per unit is rupees 30 as per the question. So the total break-even point value is rupees 12 lakh. Then B, the B question what they have asked us to solve is profit or loss of the stores if 35,000 pairs were sold. So they have told, they have given the sales here where 35,000 pairs are sold. We need to find out whether we are getting profit or loss. So now profit or loss when 35,000 pairs were sold. Now the sales when 35,000 pairs are sold, the selling price is 30,000 rupees 30. So 35,000 into 30 will give you 10,50,000 minus variable cost. So variable cost is rupees 21 per pair. So how many pairs? 35,000 pairs are sold. So 35,000 into 21 will give us 7,35,000. So we will minus sales minus variable cost. We will get our contribution, which is 3,15,000. So with this, we will minus a fixed cost to find out whether we are getting loss or profit. So the fixed cost, as per the question, given, and the total fixed cost what we get is 3,60,000. So 3,15,000, the contribution minus fixed cost, 3,60,000 will give us the loss because the fixed cost is more than the contribution. So the loss difference what we get is 45,000, which is loss. So if you are producing 35 or if you are selling 35,000 pairs, we will be incurring a loss. So the C question is, they have asked us the annual break-even point in units and sales volume if the sales commission were discounted in favor of 81,000 increase in fixed salary. So here they have asked if the sales commission were discounted in favor of rupees 81,000 increase in fixed salaries. So here the sales commission are discounted and there will be increase in fixed salaries by 81,000. So then what will be the break-even point? What we are going to calculate now. Now, if the sales commission were discounted in favor of an increase in fixed salary by 81,000, so if the fixed salaries are increased by 81,000, then sales commission and if sales commission are discounted in favor of that, what will be the sales? So the new variable cost will be 21 rupees is the total variable cost. Now the sales commission is discounted, in the sense we are deducting the sales commission. So 21 minus 1.5 is the commission. As per the question, we will be getting 19.5. So without the sales commission, the variable cost per pair will be 19.5. So in this, the new fixed cost is 3,60,000 is the total fixed cost. So how did we get this 3,60,000 is rent 60,000, salaries to 20,000, advertising 80,000, sundry expenses 20,000. Then this is the total will give you 3,60,000. And in the question they have told what will be the break-even point in units if you are reducing the sales commission and for which you are increasing the fixed salaries, fixed salary by 81,000. So now we have reduced the variable cost by deducting the commission where we have got 19.5. Now we will increase the fixed cost where already the fixed cost was 3,60,000 plus 81,000 salaries will be increased, fixed salaries will be increased, so the total fixed cost is 4,41,000. So now the break-even point units can be calculated. So the formula is fixed cost divided by selling price per unit minus variable cost per unit. So as per the increase in fixed cost, we will be getting the total fixed cost as 4,41,000 divided by selling price, which is 30, and the variable cost which is changed, which is 19.5, where you will be getting 42,000 pairs as the break-even point. So next is break-even point in values. They have asked us to calculate both in units and values. So we have got units where we get break-even point of 42,000 pairs. So next in value, just multiply the break-even point units into the selling price. So that is what is done here. So break-even point value. So the total units which we have got from break-even point units is 42,000 and the selling price per pair is 30. So 42,000 into 30 will give us rupees 12,60,000. So 12,60,000 is our break-even point in value. So next question what they have asked us to calculate is the annual break-even point in units and sales volume if the store's manager were paid 30 paise per pair as commission. So now each situation has different conditions. So in this situation, what they have asked is to calculate break-even point in units and sales volume if the store's manager were paid 30 paise per pair as commission. So now commission is being paid. So in this situation, how are we going to calculate? So now if stores manager is paid 30 paise per commission, so commission is in your variable cost. So the total variable cost what is given in the problem or what through the calculation is we have variable cost as well as the commission which is given in the question is, which is 19.5 is the variable cost and salesman commission is 1.50, which will give us total of 21 rupees as variable cost. And as per the condition what they have given in the question, they have asked us to increase where the stores manager will get extra commission where he is paid 30 paise. So when he is paid 30 paise, 21 plus 0.30 is paise. So 21 plus 0.30 will give us 21 rupees point 30 paise. So this is our variable cost. So when our variable cost is increased, what will be our break-even point? That is what we are supposed to calculate. So in units, the formula is fixed cost divided by selling price selling price per pair minus the variable cost per pair. So now 3,60,000 is a fixed cost, which is the initial fixed cost, because in this condition or in this D question they have not asked us anything. They have not asked us to increase the fixed cost. It is only relating to variable where the commission is commission has been added on. So the fixed cost will remain same, 3,60,000 divided by selling price which is 30. We will minus the variable cost which is 21.30, which will give us 41,379 pairs. So next in value, break-even point in values, 41,379 is the total pairs into the selling price will give us the break-even point value. So which will give us rupees 12,41,370. So the next question what they have asked to calculate is uh, here, refer to the original data. If the stores manager were paid 30 paise per pair as commission on each pair sold in excess of the break-even point, what would be the store's profit if 50,000 pairs were sold? So now, stores, while referring the original data, if the stores manager were paid 30 paise and if you need to get profit of I'm sorry, and what would be the store's profit if 50,000 pairs were sold. So here the total pairs are allotted where they have asked 50,000 pairs if it is sold, what will be the profit, and look in and regarding the original data, if the store's commission is there, what will be the break-even point. So let us get into the solution. So here profit when store manager is paid 30 paise as commission on each pair sold in excess of break-even point. So now the units what they have given us, the sales units is 50,000. So now sales is equal to, so they have asked us to calculate profit when commission is there as well as when the units when the sales is 50,000, what will be the profit. So sales is equal to 50,000 into 30 paise is the commission of the stores manager. So into, I'm sorry, this is 50,000 into the selling price per unit is 30. So 50,000 into 30 will give us 15 lakh. Then minus variable cost. So 50,000 into 21. So the original data is variable cost is 21 rupees. So 50,000 into 21 where we will be getting 10 lakh 50,000. So with this we will minus our store manager's commission. So stores manager commission will be charged on 10,000. So how did we get 10,000 is, if you look into the question, so in this question what they have asked us, if the stores manager were paid 30 paise commission, so that 30 paise commission was paid on each pair sold in excess of break even point. So what in excess of the break even point. So what was the break even point what we have got? So as per the original data, so original calculation is this, the first calculation. So the break-even point what we have got here is 40,000 pairs. So they have asked what we need to charge that 30 paise on the excess of the break-even point from the original data. So here the number of units what we are producing the excess of break-even point is 50,000 units. As per the question is 50,000 units minus 40,000 units is the break-even point. So the excess is 40,000 units. So that is what is told here. Profit when store manager is paid 30 paise as commission on each pair sold in excess of break-even point. So that commission will be given only on the excess units which is sold, apart from the break-even point what we have got from the original data. So in the original data is the initial break-even point what we have got based on the question which is given in the problem, so which is 40,000. So currently what is the sales you are making in this situation? 50,000. So 50,000 minus 40,000 from the original break-even point, we will be getting 10,000. So on this commission will be charged which is 30 paise, which will be getting 3,000. So 4,50,000 minus, so as store manager's commission 3,000 will give you a contribution of 4,47,000. With this you will minus your fixed cost which is 3,60,000. So where you will be getting profit of 87,000. So if your sales units is 50,000 and commission is paid on the excess units which you have sold, then you will be getting a profit of 87,000. So the next problem what we are going to discuss is illustration 17. So in illustration 17, an analysis of cost of X manufacturing company led to the following information. Cost elements, variable cost, fixed cost. So variable cost is percentage of sales. So the total sales which is given, so these are the percentage. So direct materials, direct labor, factory overheads, distribution expenses, general expenses are based on the percentage of the total sales. So we need to know what is the total sales. Yes, we have given the budgeted sales for the next year is 18,50,000. So you are required to determine break-even sales volume, profit at budgeted sales volume, profit if actual sales is dropped by 10%, increased by 5% from the budgeted sales. So let us get into the calculation. So first is we will find out the calculation of fixed cost. So the what is the fixed cost which is given in the problem is 1 lakh 8, factory overhead fixed cost is 1,89,900. Distribution expenses in that fixed cost is 58,400. Then general administration expenses is 66,700. So we will total up that, we will be getting 3,15,000. So next is our variable cost. So variable cost, the total is variable cost 32.80 for direct materials, and for direct labor it is 28.4 plus factory overheads 12.6 plus distribution expenses 4.1 and general administration expenses. So when we total up, we are not getting 100%, we are getting up 79% of sales. So your variable cost will be 79% of sales. So now let us get into the calculation. So the calculation of PV ratio is required to calculate the break-even point here. So PV ratio is equal to sales minus variable cost divided by sales into 100. So PV ratio, the sales is 100. So we will assume our sales to be 100% because the total variable cost is based on the percentage of sales. Here they have given us budgeted sales for the next year. So we will be taking, assuming ourselves or the sales to be 100%. Out of the 100%, 79% will be the variable cost divided by the sales again, which is 100 into 100 will give us 21%. So the PV ratio is 21%. So now break-even point sales. So break-even point value is equal to fixed cost divided by PV ratio. So first question we are going to calculate break-even point, break-even sales volume. So PV ratio divided, break-even point value is fixed cost divided by PV ratio. Fixed cost as per the calculation, which is 3,15,000, divided by PV ratio as per the calculation is 21 into 100, which will give us rupees 15 lakh. So 15 lakh will be our break-even point in value. Next, we will be calculating our contribution. So as per the second question, what they have asked is profit at budgeted sales volume. So what is the budgeted sales volume? 18,50,000. So when 18,50,000 is the budgeted sales volume, what will be the profit we are supposed to calculate? So to calculate that, we need to have our sales, variable cost, where we'll be getting our contribution. From our contribution we will minus our fixed cost to know whether it is profit or loss. So we can calculate our contribution. So contribution minus variable cost. Your variable cost is 79% of sales. As we don't know what is our current period sales, we will not take we will not know the variable cost as well. So we will be using the formula contribution is equal to sales into PV ratio. So sales is 18,50,000, which is your budgeted sales, into PV ratio is 21%, where you will be getting contribution of 3,88,500. So from this contribution, if you minus fixed cost, we will know whether we are getting profit. So from the budgeted sales which we have got contribution of 3,88,500 minus fixed cost, which is 3,15,000, we will be getting 73,500 as positive answer, where your fixed cost is lesser than your contribution. So we will be getting profit of 73,500. Next question what they have asked us to calculate is profit if actual sales dropped by 10% and increased by 5%. So what will be the profit if your actual sales is dropped by 10%, and if it is or if then what will be the profit if actual sales is increased by 5%. So now as we have the budgeted sales, where the new sales is 18,50,000 minus 10% if the sales is dropped. So if you minus 10%, with 10% of 18,50,000 is nothing but 1,85,000. So 18,50,000 minus 1,85,000 will give you your sales, which is 16,65,000 when your sales is dropped by 10%. So now this is the sales what we have got. So contribution formula is sales into PV ratio, which will give you your contribution. So you know your sales, which is 16,65,000, and you know what is your PV ratio, which is 21%. So 16,65,000 into 21% will give you 3,49,650. So with this the contribution, you will minus your fixed cost. So 3,49,650 minus 3,15,000, which will give you a positive answer, which is 34,650. Next, the B is what will be the profit if sales is increased by 5%. So new sales, which is budgeted sales, is 18,50,000 plus 5% of 18,50,000, which will give you 92,500. So budgeted sales or the actual sales is 18,50,000 plus 92,500 will give you 19,42,500. So the total contribution is 19,42,500 into PV ratio, which is 21%. So this is the formula to find out contribution, where sales into PV ratio will give you your contribution. So why we are using this formula is we don't know what is our initial sales which is to be made. We know only the variable cost is 79% of this sales. We don't know what is the initial sales, and we don't know what is variable cost. Only if we have sales, 79% of it will be the variable cost. We have only budgeted sales of the next year. So we will use this formula here. So 19,42,500 into 21% of your PV ratio will give you your contribution, which is 4,07,927. So to find out profit, contribution minus fixed cost will give you whether profit or loss what you have got. So 4,07,925 minus 3,15,000, which is your fixed cost, you will be getting profit, positive answer, which is 92,925. So this is the calculation for the questions which is asked in this problem. So here still as there is no sales which is given, and we will not know the variable cost as, so we don't know what is the actual sales, so we will assume sales to be 100% and variable cost is 79% of your sales, and we will be taking directly the percentage to find out the PV ratio. So that is the only difference here. So suppose you're getting such problems in your exams, please be ready to solve such problems. So the next problem what we are going to discuss is illustration 19. Motor car industry limited is engaged in the manufacture of motors. The cost structure of the motor is as under. So under the cost structure they have given as material rupees 50, labor rupees 80, variable overheads 75% of labor cost. Fixed overheads amounted to rupees 2,40,000 per annum. Selling price of the motor is rupees 230 each. So they've given us material, labor, variable overheads, which is 75% of labor cost. So how much is your labor cost? Rupees 80. So 75% of it will be your variable overheads. So 80 into 75% out of it is 60. So 60 will be your variable overheads. So now the question what they've asked us is selling price of the motor is rupees 230 each. Determine the number of motors that have to be manufactured and sold in the year in order to break even. So we need to find out what is the break even units and what is the sales. So how many motors have to be made and sold to make a profit of rupees 1 lakh per year. So to get profit of 1 lakh, what is the sales to be made is the second question. Then the third question is if selling price is reduced by rupees 15, what is the new break even point? So as you all know, break-even point is a situation where we get no profit, no loss. So the investment what you have made will be equal to the cost, investment or the return what you are getting will be equal to the investments what you have made. So cost and revenue will be the same. So as per the information given, let us calculate first the break-even point. So now let us calculate the cost. So materials 50, labor 80 and variable overheads is 75% of labor cost, so which will give you 60. So now 50 plus 80 plus variable overhead 75% of labor cost, which is 75% of 80 will give you 60. So the total variable cost per unit is rupees 190. So now to calculate break-even point, the formula what we have is fixed cost divided by selling price per unit minus variable cost per unit. So your fixed cost as per the question is 2,40,000. The selling price per unit is rupees 230. Your variable cost as per the calculation is rupees 120 per unit. So 2,40,000 divided by 230 minus 190 will give you, so 230 minus 190 will give you 40. So 2,40,000 divided by 40 will give you 6,000 motors. So the break-even point units at 6,000 motors. So you have calculated the break-even point. So if you manufacture more than 6,000 motors, there is chance for the manufacturer to get profit. So we have determined the number of motors that have to be manufactured and sold in the year in order to break even. So to get profit, to get profit, we need to produce more than 6,000 motors. So if you're producing more than 6,000 motors, we will be getting profit during that year. Then the second question is how many motors have to be made and sold to make a profit of rupees 1 lakh per year. So here profit is given, so we need to find out the sales. So sales formula can be used where sales is equal to fixed cost plus profit divided by selling price per unit minus variable cost is the formula. Here they have asked us how many motors. They are not asked the sales price, selling price or the sales value. They have asked units. So formula of sales units will be taken. So the formula for sales units is fixed cost plus profit divided by selling price per unit minus variable cost. So your fixed cost as per the question is 2,40,000 plus profit. What you are going to the profit what you should earn is 1 lakh. So plus 1 lakh divided by selling price per unit. So what is the selling price per unit as per the question, which is 230, and your variable cost per unit as per the question or as per the calculation what you have got is 190. So 2,40,000 plus 1 lakh, which will give us 3,40,000 divided by 230 minus 190, which will give you 40. So 3,40,000 divided by 40 will give you 8,500 motors. So if you want to earn profit of 1 lakh, you need to produce or you need to sell 8,500 motors. So the next question is, if the selling price is reduced by 15, what is the new break-even point? So what is your selling price? The selling price is 230. So 230 minus 15, if it is reduced, so you will be getting 215. So now to calculate the break-even point units formula, so they have asked us break-even point. If the selling price is reduced by 15, what is the new break-even point? So to calculate the break-even point, the formula is fixed cost divided by selling price per unit minus variable cost. So now what is your fixed cost is 2,40,000. 2,40,000 divided by the selling price. If it is reduced by 15, you will be getting 215 minus variable cost, which is per unit is 190. So 2,40,000 divided by 2 lakh, I'm sorry. So the fixed cost is 2,40,000 2 lakh 15 minus 190 will give you 25. So 2 lakh 40,000 divided by 25, you will be getting 9,600 motors. So 9,600 motors is the break-even point if your selling price is reduced by 15. So thank you everyone. The other problems will be discussed in the upcoming videos.